Hi, class. Welcome to Chapter 9, Behavioral Finance. Um, this, this chapter kind of starts off with a really bad joke. I don't know if it's worth telling you, but two professors, who really believe in this efficient markets theory, they're walking down the street, and lo and behold, they see a $20 bill on the sidewalk. And the one professor says, "Hey, let's pick up the 20 and go out for lunch." And the other professor says, "No way in the world would someone just leave $20 sitting on the sidewalk for us to take." Efficient markets, right? There is no way to beat the market. And so anyhow, they keep on walking. But sometimes $20 is left on the sidewalks, right? And so that's kind of real world. So anyway, like I said, I apologize for that joke. Not really much of a joke. So let's take a look at what we've kind of talked about the last couple chapters. And give me a second here to put these controls. Give me a second here. So we just talked about the efficient markets theory, right? And then we showed how, well, the efficient markets theory isn't always correct, right? And we saw these market anomalies, right? And so now the question is, okay, how can we, how do we justify this? The fact that we have this theory that seems like it should work, but then we have these observations that show it's not always working. And so that's where one of the more relatively newer areas of finance comes into play. It's called behavioral finance. And what it does is it borrows studies and findings from psychology and sociology to help explain the anomalies that we see in the financial markets, right? Because if you think about it, um, finance is actually a social science. It's not a physical science. It's as much as we like to use equations and think about physics and stuff like that, and for every force there's a positive, there's a reaction, and be able to calculate things, but it doesn't work that way. Those calculations are the way we think things should work, but whenever humans get involved, it doesn't always come out the way it should be. And so it kind of makes sense that, this is a social science. Somehow we need to bring the human element into this. And that's where psychology and sociology come into play. So the idea is that these anomalies exist because human behavior includes certain biases, or when I say biases, what I mean is we consistently make certain mistakes over and over again. And these biases or psychological biases, these mistakes we make, can affect how we value securities and the trades that we make, and ultimately the markets themselves. Excuse me. So let's do a comparison of efficient markets and behavioral finance. On the left-hand side, we have efficient markets, and let me just change. I'm going to change my color here. Why don't we make it blue? Okay, so here we've got efficient markets, and then over here we've got behavioral finance. So efficient markets, right? We think that most investors are rational, and that when investors trade or invest, they do so based on on rational decisions, like what is something worth based on future cash flows, right? And then efficient markets thinks, okay, well, what if we do have some traders who make mistakes? They're irrational. The idea in efficient markets is that these traders kind of cancel each other out. one person makes a mistake in one direction and another person makes the mistake in the opposite direction, and then they kind of cancel each other out. And then efficient markets also thinks that, okay, we have these rational big investors who know a lot more than most other people, and whenever they see arbitrage opportunities in the market. Arbitrage is technically a riskless profit trade, but it's maybe used a little too often than it should be, because even in situations that maybe aren't riskless, we call it arbitrage. I think because it's kind of a neat name. So rational arbitrageurs should be able to eliminate these mispricings in the market fairly quickly by making big trades. Right? If they see something that's underpriced, they're hurry up and going to buy tons of it, tons of it, and then drive the price up. Okay, so that's kind of market efficiency, kind of the thought process. Now let's take a look at behavioral finance. So here it's saying, yeah, investors are rational. Okay, they make decisions usually on what they think is the future is worth. But here's the issue. There are irrational traders as well, and those irrational traders, they tend to make all the same mistake at the same time. The people who make the mistakes do not cross each other out. They don't cancel each other out. Instead, we as like a species, human race, we often, a lot of us all make the same mistake at the same time. And this can cause the entire market to get a little crazy sometimes and cause mispricings to exist and stay potentially for a long time. And it's saying arbitrage, the ability to make a profit based on, if you're one of these, smarter, omniscient investors, and you see this pricing mistake, they're saying it's a lot harder to do it in this behavioral finance realm, because you don't know when the market is going to return back to its true intrinsic value or rational price, right? Because it's not always easy to like move the market, one little trader to move the entire market. And so under behavioral finance, you can see these mispricings, and they can exist because we have a lot of traders who are making the same mistake at the same time, but your ability to profit off that mistake is limited because you don't know how long that mispricing will last in the market. So the idea is in behavioral finance is that markets are quasi-efficient with some persistent anomalies or persistent mispricings in the market. Here is an example of some of the behavioral biases that investors seem to have. The first one here is overconfidence, and and I think this one is maybe a little related to some people they get kind of they find enjoyment in taking lots of risk. And so some of this stuff we're going over here, it's backed up by a lot of scientific research studies. Usually it's done on students, who are trying to, they have a side job of doing a job at the university, and they become test subjects. And so overconfidence is, as you can imagine, it's people being overconfident or misjudging their abilities. But the other side of it, which I think is somewhat related, is some people having this they get a lot of enjoyment from performing excessively risky behavior, right? And they've done some scientific research, and what they did is they had people like hook up to like these electrodes, and I think they also did some with MRI scans, and they found out there's a certain cortex, or I forget what they call it, some part of the brain that lights up when you like have enjoyment or something like that. And they found that for some people, when they start doing like risky gambling and stuff, it's like their brain lights up like, oh, this is incredible. I could lose $2 million. I love this. And so anyway, sometimes some of it was found like the overconfidence. They found kind of like seemed to directly correlated with testosterone. So read into that what you want. So here are some of the implications of overconfidence. Investors overestimate their ability to forecast and pick stock winners. And the implications on this, what results from this is that we see a lot of day trading activity because a lot of the research shows that day traders, retail, day traders, small traders end up losing money. And investing in trading and options, day trading, people try it, but then most people end up losing significant amounts of money that they thought they were investing, but really it's almost more like gambling then. A lot of active management where people are trying to pick winners and losers, and any other type of like speculative investing behavior. Let's take a look at the second one, herding. So this is where, investors, you're looking for what other people are doing to kind of give you confidence that you're doing the right thing, right? And we think this might help support that. Remember we talked about momentum, when stocks that are winners for a certain amount of time tend to be winners again for another period of time. And so stock prices seem to have momentum where once they start doing really well, they just keep doing really well because people keep jumping on. And we think this is, kind of emblematic of herding behavior where investors are watching what other investors are doing. And maybe you could call this, what is that? FOMO, right? Fear of missing out type thing. Maybe that would go under here as well. And then we have conservatism, and that's where investors are slow to revise their forecasts of what they think is true or will happen. And kind of what this means is that, like, if let's say you have a picture of what you think will happen with different stocks or something in the world, and if you get information that comes to you that's contrary to what you believed, a lot of investors will ignore that information, and they'll put more focus on the information that comes in that kind of corroborates what they think. And so really they should be taking in all the information. They shouldn't just ignore some of it because, oh, you know what, that doesn't really make sense to me. I'm going to ignore that, right? And so, so if that's the case, and this is talking to momentum again, if you think about it, like when a company announces earnings, that's a big surprise to the world, earnings announcements. This might help explain why, why stocks continue to do well over several weeks after a surprise earnings announcement. And if there's like favorable news that's like different than what people have normally seen, so this is where it's contrary news, and people were being like really pessimistic about something, but then all of a sudden there's good news. It may point to the fact that maybe you should take into account and maybe trade on that. I'm not saying you should trade on that. You might be overconfident, but and it might help here again support that initial type of momentum where a stock does well and not everybody jumps on it, and it takes time for people to think, oh yeah, it is really doing well. I was wrong on that. So then they jump on too. So that's another potential explanation for momentum. It's basically, you think about momentum and this conservatism and herding, it's like we used a couple biases here to try to explain why stock prices don't react immediately. It takes time for the market. Think about this whole AI thing. You know, in 2 years, we all might be looking back and like, oh my goodness, look how big this is, and maybe I should have put a lot more investment in this. But we're kind of waiting to see, is it going to take off, right? Is it going to take off some more? I'm not sure. Let's wait and see. Um, the disposition effect here, and that is where holders, let's say you bought a stock, you thought it was going to do well, but then it turned out to be a loser. It dropped in value a lot. And what we see is people, more so than what we expect, tend to hold on to those losers. And the idea is that people hold on to losers because once you sell, you're kind of like admitting that you made a mistake and you have to fully recognize that loss. Because as long as you own it, as you still hold it, you can always say, oh, it's down now, but it could come back someday, right? So even if you think another stock is probably a better stock, you may still hold on to this loser. And so the idea here is if people are slow to react to negative surprises because of this disposition effect where they don't want to sell losers, the idea is when you do see a negative surprise on a stock, well, maybe you should really sell it. And this is all investment advice, everybody. I'm just going through, just trying to understand the science of finance here. Reference points. Sometimes we seem to see price points in the market, usually like big round numbers, where the market price will go up on something, but then it kind of like it flattens out. And sometimes you see that when the market prices get close to some really big numbers, like S&P 500 5,000, S&P 500 6,000. It's like, whoa, that's a big jump. And so people sometimes hold back when it starts getting up close to that level. And so we think this could help us understand why we have support and resistance levels on stocks, which we will cover in a little while. And then we have mental accounting. And mental accounting is where instead of looking at your entire financial picture, people tend to look at like little buckets of what they have, and they make decisions within those buckets instead of looking at their entire investment portfolio. Let me give you an example. You may have heard the term playing with house money before. And so that's when somebody, like, let's say they go gambling and they place a bet and they unexpectedly get a big windfall. They make lots of profit. What we found is that those people, students under laboratory research, just kidding, sorry, they tend to change their risk appetite for gambling then, right? So if they went in saying, oh, I'm just going to gamble so much and then that's it, they have a budget or whatever, right? Because they're thinking about how much money they have. But then all of a sudden they win some money and they might gamble the whole thing away again. And because they're thinking the way they're thinking about this in its own little bucket, this one money, it's like, oh, this is free money. I can just do whatever I want with it. I'll gamble it. I won't worry about it. But if you look at it from the perspective of your entire portfolio, you might say, oh, now we have all that money. If we're going to gamble more, we should only gamble like a small part of it instead of all of it. It's not all found money. Now it's part of your big portfolio and you have to be responsible for it. So that's mental accounting. And we think this is what might help create bubbles in the stock market where if you invest in a stock, the stocks explode in value, and now people start putting more and more money into it, when in actuality, if you look at your whole portfolio, you might see, oh, I better take some money out of the stock market because now I have too much of my asset allocation there. So we talked about one of the issues that behavioral finance identifies is that if you see a mistake in the market, right? And you think that, oh, let's trade on this mistake, and we often call that like arbitrage. It's like where you do a trade and it's seen as pretty riskless. A lot of times, arbitrage, if you go back to it, it's a riskless profit. And to make it riskless, you have to like buy something in one market and then sell it in another market. And that way you're not incurring much risk. But and so sometimes with arbitrage, they might like take a stock and they see it's mispriced and then go over to options market and buy a combination of different options to that would that kind of emulate the prices the pricing of a stock in terms of how much profit you get when the stock goes up, how much profit you get when the stock goes down. Buy some options that kind of give you that same payoff structure. And it turns out, depending on how those options are priced, it might be cheaper to do it over here. And so sometimes that's kind of where it started, really. But you know, it doesn't always work. And part of the issue is, one, you see the opportunity, but you might not have the money to be able to finance the trades to take advantage of it. So these are some of the limitations to arbitrage. You may not be able to find perfect substitutes. What I mean by that is, let's say you see a small company stock and you want to short it, think GameStop, but even smaller. Sometimes you cannot find those small stocks to short. And so there is no security you can buy to profit from a stock, a very, very, very small stock that's overpriced. Sometimes prices can get more irrational before they go back to where they should be. And sometimes if there are high transaction costs, like margin requirements, fees, bid-ask spread, those transaction costs can eat up a lot of your profits, right? So that's why, those are some of the reasons why it may not always be easy to profit, even when you see some mispricing in the market. So this takes us to technical analysis, and I think it's a little weird that technical analysis is in this chapter. Personally, I think it goes to show you that technical analysis is not fundamental analysis, which we're going to cover later. And I think part of it is because a lot of people don't believe in technical analysis. But let's take a look at what it is, because I think if you watch any type of financial market news, CNBC, you'll probably hear some of these terms thrown around. If you watch YouTube videos on how to make $10 million in your pajamas, you'll probably see videos talking about this stuff. And so technical analysis, it focuses on the supply and demand of a security. And the key here is it's looking at historical stock price and historical trading volume. Okay? It's not taking the present value of future cash flows and coming up with a value. This book is kind of one of the, I don't know if premier books on it. It's one of the ones that kind of started it. In fact, I have the book here in my bookshelf. It's okay. I wouldn't necessarily recommend it. If you wanted to read more about this, I would go do some research and see if there's some. I think there's probably some better books about it, but this book, it's like one of the originals. It defines technical analysis as the study of market action primarily through the use of charts for the purpose of forecasting future price trends. Peter Lynch, you can look him up. He's got a couple books. He was a famous investor from like 40, 50 years ago. He called technical analysis the science of wiggles. But here's the thing. It's still widely used to analyze all types of things, but especially securities where you cannot calculate the fundamental value. Think about gold. Gold has been in the news quite a bit lately, right? If we wanted to take the present value of gold to figure out how much it's worth, How would we do that? If you buy 1 ounce of gold, right? What are the cash flows we get from that? Nothing, right? Maybe if you bought stock in a gold mining company, we could probably do that. But what if you bought um, I don't know, you know, a pallet load of coffee beans? Should you buy it now? Should you buy it in a month by analyzing the prices in the markets? How would you do that? It's hard to, right? So what it comes down to on some of these securities in the markets, it's basically supply and demand of a product. And so how do you analyze the supply and demand? You look at the price. Is the price going up? Is the price going down? How much trading volume is going on? So technical analysis kind of assumes, I can't calculate the value of something, but I can try to figure out what's happening behind the stock prices and trading volume to figure out is demand more than is demand greater than supply, which will drive the price up, or is the supply number of people want to sell greater than demand, in which case the price will start going down, right? And so it's kind of predicting future prices based on looking at the supply and demand. And how do you pull that out of a price chart on a stock? So that's what this area tries to do. I think one of the first things that started this is called the Dow theory. And this Dow theory kind of um, separates technical analysis into the process of identifying where you are in a trend. Because the idea is, if the stock is trending up or trending down or going sideways, we want to try to predict that to help us identify whether or not we should invest in something, right? And so what this did, and I apologize, I can't give you a lot of scientific studies that have been done to kind of justify this. I think a lot of this stuff comes from people who've been staring at price charts for hours and hours and hours into the night. They're probably like going into caves and they got candles and they're just staring at charts trying to be able to forecast the future. And so one of these, Dow, which I think comes from Dow Jones Industrial Average, right? Breaks it up into these three trends. So we got the primary trend. That's a long-term trend lasting from 3 months to multiple years. Intermediate trend, which is just a couple weeks to a couple months. And then minor trends, which are like the daily price movements. Okay? So like this right here, you see over like 3 years, the price has generally gone up and up over 3 years. That would be a primary trend. Look at right here. You see how it was going down, then it went up, down. So this part right here, that would be an intermediate trend because it's only lasting like a couple months. But then in here, do you see all the little tiny ups and downs? That's the minor trend. You can think of the minor trend as like noise, right? It's just people buying and selling every day and prices go up and down a little. Just ignore it. But sometimes if there's more demand than supply, you start getting a price trend. There's someone out there who wants to buy something up. And they can't buy it all in one day. And so they keep buying and keep buying. And what happens when someone just keeps buying and buying stuff, the price goes up, right? Because if you're a seller and you see everything being sold out, you're going to raise your prices. Imagine if you were a car dealer and right, everybody was buying Honda Accords. Now all the Honda Accords are off your lot. But now you just got a shipment of Honda Accords. Well, you're going to raise your prices because you see they're flying off the shelves, right? They're flying off the lot. And so might as well raise your prices to um, to increase your profits, right? Here's a one of the interesting tricks I think from technical analysis is so right. This is an example of a price chart, right? When you look up a stock, you go to Yahoo or whatever website you want. You look up a stock, and at some point on that page, you'll see a price chart. And what it shows is you've got time in the horizontal scale, right? And the charts usually you can adjust to have show different time periods, right? And then over on the vertical scale, you've got price, right? Right? And so that's what we mean by a price chart. It just shows price and how it's changing over time. But here's the thing. I don't know if you remember from Finance 300. Did you guys look at a chart, right? Was it, I think it showed the future value of $1. Like you invest $1 today, right? And you keep it invested and you reinvest all your interest over time. And what is the value of that dollar you invested on day zero? What's its worth going to be in the future? And if you recall, it's kind of related to what we call uh, um, the magic of compounded interest. I think even Einstein said it was one of the most wonderful things in the universe was the magic of compounded interest. Because what happens is, and you'll see that this value of a dollar invested and then all the future profits reinvested over time grows like this. Sometimes we call that like a hockey stick, and and it just keeps going up and up. And so we see this compounded growth. And so the point here, remember, in technical analysis, we're trying to identify trends. And when you see something like this, it's hard to identify a trend. So the trick here is put the scale here on the right, put it in the log. I don't know if you remember a long time ago, you take the log of a number. So if you take the log of price P here, and now your vertical scale is the log of price, it takes compounded growth like this that looks like a hockey stick and it linearizes it. Now it's easier to identify an upward trend because it's a straight line. So that's a trick you can do. I've seen it used with investment companies that focus on different countries, right? Because the idea is like if you've got a big homogeneous country and and you're just looking at the economy, like should you invest in this country or that country? Countries often grow on a compounded growth rate over time, right? And so if you just looked at that, you would see something like that. But if we take the log of it, it looks like a straight line, right? Now, what would happen if you looked at the value of the index for the country, and let's just say it looks something like this over time, right? And so this one investment company, what they would do, they would like put it on a log scale and kind of do like, then you start seeing a line somewhat. And their idea was the country is going to grow on a compounded growth rate on average over time. But there are times with the business cycle when when they kind of like hit a bubble and they crash, but then they hit a bottom and they start going up. So they would look at this line and basically buy on these low parts down here and sell on the high parts because they see this trend, and then the business cycle is going up and down across that trend over time. So that's just an example of where I've seen it used before. Okay, so now let's take a look at one of the most common measures in technical analysis. It's called moving averages. And the idea here with a moving average is let's do it just for a couple days here. So I'm going to say days, right? So we got 0, 1, and then we're going to do stock price P, and let's say stock price is 10, I don't know, 12, 14, 16, 20, and 18. Okay, and now what we're going to do is we're going to calculate the 2-day moving average. So MA stands for moving average, and when I put in this 2 in parentheses, I'm just saying I'm going to do it over 2 days. So now the idea is you calculate the average stock price for the last 2 days. So I can't do it here because I only have one pricing data, but here I look at these 2 prices the last 2 days and I put the average, which is 11, right? And then here I look at these 2 prices and the average is 13. So the average days I'm using keeps moving. That's why it's the moving average. Here I would have $15, just look at the last 2 days. Here's $18, right? And here's $19. So I'm always looking at the last 2 days, right? And so that's why it's called moving average. So the idea here with a moving average is that I think, one, it helps take away some of the daily price movements, right? And it kind of shows you, depending on how many days you use to calculate your moving average, it helps you see the trend on these intermediate and long-term trends, where the price is going. And actually this technical analysis using moving averages, it actually gives you ways on the price charts to identify when you should buy and when you should sell. And this is what kind of makes it pretty tempting to use as a strategy, right? Because, I mean, who wants to calculate fundamental analysis, fundamental value of a stock? You know, analysts can spend weeks doing it for one company, and they only get a number, and then what, right? Should you buy? Should you sell? Depending on how much it is compared to the current price. Moving average. Let's take a look at this. Actually tells you buy or sell. So the blue line here. The blue line is the Dow Jones Industrial Average. Okay, and the green line is the 200-day moving average of the industrial average, right? And the idea here is whenever you see these 2 lines cross, it means that the price is changing from the trend. Something has changed, okay? And so first off, you can see like right here, they cross, right? And then right down here, they cross again. And so think about it as the green line, the moving average shows the trend. It's trending up. And the price is going to change quicker, right? Than the moving average. And all of a sudden, when the price, the blue line right here, goes down through the moving average, it means the trend is changing from going up to going down. And so when the price goes down, this one right here, through the moving average line, it gives you a sell signal. Okay, and when the price of the stock moves up through the moving average, meaning now the trend has changed again and the price is moving up instead of down like it had been, that gives you a buy signal right here. So you plot the moving average line on this chart. And you know what? A lot of websites nowadays make it really easy to plot this on there. And then you basically look for that. Trading volume is another piece of data to use in technical analysis besides price. And the idea here is that when you have high trading volume, it kind of makes the price movement that you're seeing more important. It's saying pay attention to this. But if you have very little trading volume, it's saying kind of ignore this. It's just random noise, right? So the idea here is if you see stock prices up plus high trading volume, then that is a bullish signal. Bullish means positive, stock price is going to go up. But if the stock price is up and there's not much trading going on, then it's saying kind of ignore it. If the stock price is down with a lot of trading volume, it's saying this is a bearish signal. Bearish meaning we think the price is going to go down. But if the stock is down on very little trading volume, then it's considered a false signal. Ignore it. Again, there's not always a lot of intuition behind some of this stuff. A lot of this, it's almost like tribal knowledge from people observing the markets and recording things that they feel seem to help predict, like signs that they see that help predict something coming. So here's an example. Let's take a look here. What is this? Let's look at that. So the blue line is Chevron. The purple line is the 50-day moving average. The red line is the 100-day moving average, and the green line is the 200-day moving average. So the idea here is if you want to identify longer-term trends, you use more days in your moving average. So I think about 200 is about the max I've seen. And you figure there are 5 trading days in a week, right? So 200 days represents about 40 weeks. So it's the better part of a year. 50 days represents about, 50 divided by 5 days per week. So it represents about 10 weeks. Okay. Depending on holidays and stuff like that, it could be close to 3 months. Because, they're actually, I think they're about 260, 70, 250, 260, 270 trading days in a year. So 200-day moving average is not quite a full calendar year. All right. So longer term moving averages predict longer term trends. And look at it. So like right here, that's a sell signal, right? Because the price line is moving down through the moving average, right? The trend has been up in general, kind of like that, right? And now all of a sudden the price goes down through it. Oh, the price is going down. The trend has changed. It's not going up anymore. Let's sell. But the different color lines kind of like affect your selling behavior, right? Because one of them had you sell a lot earlier than the other one. And that's because the purple line is looking at shorter term trends, so it's a lot more sensitive. It's going to have a lot more buying and selling. So check this out. The purple line, look at all this buying and selling it's doing here. Buy, sell, buy, sell, buy, sell. That's what it's doing. Versus the green line, there's not a lot of trading activity. You've got one trade here, and then here's your next trade, right? But the purple one has got all these trades going on here, right? Lots of trading behavior. I will say, you look back at this, and I would say, just look at some stocks yourself on some of the charts on some of the websites, and it is kind of tempting, especially if you look at it before market crash. This is where, wow, I wish I would have used this before when the market was crashing, so many years ago, right? And I would have gotten out, right? And that's the kind of thing it's kind of tempting when you see this, right? Because I mean, look at this. It would have gotten you out and it would have spared you a lot of this pain going down here. But it's a little dangerous. It's hard because I also seen where sometimes the price will go down to one of these 50-day moving averages or 200-day, and then it just kind of hovers around it. And then maybe it crosses over, but then it goes right back up. And that could kind of drive you crazy a little. And here's the thing, it's not foolproof, and it's not foolproof because there are professional investors who make their living 100 hours a week living and breathing this stuff, right? And they know that there are other investors who use these moving averages to trade on. So if you're a big investor and you want to buy up more of a stock and you're like, wow, I want to buy it, but I don't want to drive the price up. Why don't we sell a bunch of it, which seems counterintuitive, and drive the price down to below one of these moving averages, and that'll trigger a lot of other investors to start selling, and then we'll go buy it back at a lower price. So it's almost like a game of chess. If they know what you're doing and the decision rules you have, and if they're a big enough investor, they can start manipulating the price in the short term and cause you to do trades that maybe make it easier for them. And so that's the only reason I would just be very careful using some of this stuff. Computers, automated models, do probably over 90% of the trading easily on the stock market now. And so a lot of this stuff is all programmed in. The different trading strategies are almost like different bots. They have different trading strategies for these different bots. And some of them, you have to be careful. That's my only comment on that. All right, this is support and resistance levels. Remember one of the biases we were thinking about, how when people have reference points, right? They see like big numbers. And so check this out. Right here, this level right here was I think it was the Dow Jones Industrial Average of 1,000. That's 1K. It's kind of hard to read. Sorry about that. Right? And so the idea here is it almost looks like there's this artificial ceiling, right? We call it a resistance level. Like the price just keeps going up, but it can't cross over. And so the idea from a technical analysis standpoint is to try to identify stocks or the market when it looks like this. And now the idea is to wait for the time period when it crosses over that resistance level, because that gives you a buy signal. Okay, and so that's this resistance level. All right. A support level is kind of like a floor. So let's say you see something like this, the stock doing this, right? And you see like, wow, it's like there's a support level or a floor where the price just doesn't want to go below. And so the idea here is after you identify one of these happening, wait until the price does break through, and that will be a sell signal. Because it's saying the trend is changing, something has happened, and now the price is going to go down. How far? We don't know, because it's broken through this this floor or support level. And I think one way to think about some of this technical analysis stuff is like, there's some big investors out there, and we as small investors, we can't always see what they're doing behind the scenes, right? And so when they trade and they make a big commitment to have a big position, one of the things they have to do is like, they got to think, wow, I don't want to like telegraph my strategies to people until after I buy up or sell everything I want to sell. So they kind of have to hide what they're doing, because it is a kind of a competitive game out there. And so if they want to sell something, they're going to sell it in little pieces, right? And if they're selling it in little pieces, and then they see the price like going up or down, then they stop. And then they go back to selling a little bit more, and then if the price starts going down, they stop. And so this leads us into the next slide, because this investor behavior about trying to hide what they're doing and not affect the price. Because if they want to buy a bunch of stuff, they could buy it in one day and offer like 50% higher price, and all of a sudden everybody will start to sell. But they don't want to do that. They'd rather keep the price low and just buy a little as sellers come out. But if they start buying too much and the price goes up, then they have to hide it, right? And so that's where that's the way I kind of envision this next slide. And I think this is maybe some of the funniest parts of technical analysis. Let me show you what I mean. So people have stared at these price charts for hours upon hours upon hours. And guess what? They start seeing things. And they think they see certain patterns in the price charts that help predict where the price is going to go. And we've broken these down into two groups: reversal patterns. So if you identify a reversal pattern, it means that the trend that you've been watching, if now you see this reversal pattern, the trend's going to change and the stock's going to go the other direction. A continuation pattern means the stock has been going a certain way. You see this pattern in the stock price, a certain shape up and down, it's going to keep going. Okay? So let's take a look at the reversal patterns first. First, we have this thing called a head and shoulders. So the idea here is, okay, we've seen this stock. Let's imagine this is a stock price chart, right? And you look at this and you're like, wait a second, that looks like a head and shoulders pattern. That's what we learned about in class. It's kind of like this a little. And if you see that, it's a reversal pattern. And what it's saying is the recent trend of going up is going to reverse, and now the stock is going to start going down. That's the head and shoulders. And kind of the neat thing about this head and shoulders pattern is it actually gives you a price target of how far the stock will drop. So if you were to draw a line from the shoulders here to the top of the head, I know it's maybe I should draw it like this. All right, so these are the shoulders, or this is the bottom of the shoulder, the neckline. So we call this the neckline right here, right? And this is the top of the head. So this distance right here is basically how far the stock will drop from the neckline. So this is going to be your price target. This distance right here is just this, is the head minus the neckline. So let's say this is $50, right? And this is $45 on your price chart, right? This is our price chart we're looking at, right? So if you see this, it goes up and down, $5 up and down. It means it's going to go down to $40. And that's what this is. So the neckline is 45 here. The head is 50. And the neckline is 45. Okay, so this is $5. That's the actual height of the head, right? And that's how far it's going to drop from the neckline. Some weird terminology. I didn't come up with this. But the people who did are probably sitting in a nice house in the island somewhere, right? All right, the next one is inverted head and shoulders. And that just means like the stock has been going down, and now you see an upside down head and shoulders pattern, and it's saying that now it's predicting that the stock is going to go up. Okay? It's a reversal of a downward trend. Then you have a double top, which is just like that, right? Then you have a double bottom, and those are just reversal trends again, right? The stock has been coming down, and now it's going to go up. In the double top, the stock has been going up, but you see this zigzag, and now it's going to start going down. And so here again, this is where I get the feeling that, like, just think of like some big investors out there on, let's say, on this head and shoulders, right? So they've had a stock, it's gone way up in value, right? And let's suppose they're like, you know what, we need to get out of this. The price has gotten really high. I want to start taking profits, right? So they want to sell. Do they sell it all in one day? Probably not, because if they sold it all in one day, the stock would probably crash, right? Because if only like, let's say, 100,000 shares sell in a day on average trading volume, but they want to like sell 200,000 shares, and they're going to flood the market with these sell orders, and the stock price is going to crash. So what they do is they just keep throwing out little orders over days, right? And then as soon as they see the price starting to go down, what do? They stop selling. Let's stop and let's let the price go back up a little, and they wait. And then they start selling again. And it goes up, and they get back and they stop. So they keep doing little pieces to try and make sure that they don't affect the price so they can sell it for the maximum price possible. This is a saucer. It's like over a long time period. I saw this with Apple stock some point in history. I can't remember when. But again, the stock has gone down. You look at it, it looks like a big bowl, and then it starts going up. And then this is an interesting one. This one always makes me think of GameStop right here. You see a stock and it'll do this. Like just in a day or two, it'll just spike up and then right back down. And that's often associated with something called a short squeeze, right? A short squeeze is when there are a lot of investors who are shorting a stock. But then positive news comes out and they all want to get out of their short position. And they all have to do it on the same day because there's good news. And so what do? They have to close out their short positions. And you close out your short position, right, by buying the stock back. And a lot of people buy the stock back, boom, the stock price is going to go up. Continuation patterns. So here the stock has been going up, right? And then you see something like this. That's called ascending triangle. And it means it's going to keep going up. Then you have something like this. It's a descending triangle. And the stock is going to keep going down. Then we have something called the flag, right? This is a flag, right? Looks like a flag, kind of, in a way. It means if the stock has been going up and you got that flag, it means it's going to keep going up. Then you have a pennant. A pennant is kind of like a triangular flag. So it looks kind of like this. And if you see that and the stock has been going up, well, then it's going to start going back up again. So this, if you kind of like squint your eyes a little, you can see this looks like a flag here, right? And this looks like a triangular flag, or what we call a pennant. All right, so those are the main chart patterns. There are others, and then we have some other stuff here. We've got some other technical indicators. We got something called the put-call ratio, the outstanding volume of put options to call options. And put options are bets that pay off when the stock goes down, and call options are basically bets for the stock to go up, right? And so if this ratio, put to call, if it goes up, it means there are more puts. More people are betting on it going down. And so that's a negative signal. And where, the future may be bearish. The level of short interest is basically related to how many shares are being shorted in the markets. And you can look this up for the New York Stock Exchange. And so the more shorting there is, that's a bear signal. And that's it for this chapter. And I'll talk to you guys in a little while. See you later.